we are going to go over a really quick, what the heck is a bond? A bond, you might be too afraid to ask, is just an IOU. It is a financial instrument that says, if you give me this amount of money, I'll give you this rate of interest back. It is not more complicated than that. They can be issued by governments, municipalities, corporations. Mike, how would you explain a bond to someone who's never heard of one before?
Yeah, a bond is a loan. The loan is split up into different increments, fractionalized shares the way a company would in the form of stock, typically in about $1,000 increments. So that loan has a couple features that are important to know about. One, and we're talking about standard bonds, there's nuances to this, but a standard bond is going to be a $1,000 increment. It's going to have a stated coupon or fixed rate of interest, say 5%. That coupon is typically going to be paid in semi-annual installments. So for a $1,000 bond, you're going to get $50 a year. If it's at 5%, it's going to be $25 every 6 months. Now, the other nice thing about a bond is we know, hey, we're going to make this loan of $1,000, but we also know when we're going to get that $1,000 back. That's called the maturity date. And so there's typically different increments that you could, have a bond, common or 5 to 10 years, and we make the loan, we collect the interest, and at the maturity date, we get our money back. Where it gets a little bit more nuanced is what happens in between when that bond is issued and when it matures, because the bond price will fluctuate with a number of different factors. One is interest rates. As interest rates go up, bond prices go down. The reason is going back to that example, if I had a $1,000 bond that's paying 5%, $50 a year, let's say it was issued by Pepsi. Next year, interest rates are higher. Coca-Cola, similar type of company, is issuing bonds, but they're paying 7%. If we wanted to sell that bond that was paying 5%, someone says, well, I could go get one from Coca-Cola right now that's paying more than that. I'm not going to pay you the full amount. So what happens mechanically is the price of the bond is adjusted down so that the income divided by the price equals the prevailing market rate. The other thing that you need to be aware of when you're talking about bonds that could be impactful is credit risk. When we talk about a non-government bond, we are concerned with the health of that business because let's say it goes bankrupt, we risk not only missing out on our interest payments, but potentially our principal as well. And so credit agencies, they will rate different bonds and they come in the form of, AAA is the highest rating. The government made news recently when the United States debt was downgraded from AAA to AA. Risk of default is presumably higher in the rating agency's eyes. So those are the main things to be aware of with bonds. The other thing that can impact the interest rate would be the term to maturity. Typically, you have a longer amount of time that you're making this loan, the higher rate of interest that you would demand in return. About 10 to 15% of the time, you have what's called an inverted yield curve, which the yield curve essentially plots on here's the stated rate of interest, here's the amount of time I'm going to make the loan. You would think that the longer you're going to make the loan, the higher rate of interest that you would expect. Today, you're collecting a higher rate of interest for shorter dated bonds. And so that's why it's termed an inverted yield curve. It doesn't typically happen very often, but it's an important economic signal because these types of events tend to predate recessions. So
why do bonds move? They move when the interest rates change, interest rates go up, the price of the bond goes down. Opposite is true. So if they're lower rates from today, your bond prices will go up. They come back to what Mike is calling par, that $1,000. If you hold it to maturity, if you have a very long-term bond, it's going to be a very long time before you get to maturity. So you see those prices move a little bit more.
The longer term that bond is, the more interest rate risk you're going to take as well.
So it's going to move a little bit more. So that's what a bond is. Don't be afraid to ask us again or watch it again. Subscribe below so you get the updates from us, and we'll talk soon. Hey guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.